The basics of currency value: the United States dollar, USD, the euro, EUR, the Japanese yen, JPY, and the Indian Rupee, INR, are all examples of national currencies. Each nation has its currency. In terms of value, these currencies are not comparable. When compared to another currency, the value of one currency is referred to as the exchange rate. As an illustration, an American dollar is equivalent to around 150 Japanese yen. In other words, this does not imply that Japan is a poorer country than the United States. Rather, it just indicates that Japan's currency is denominated in smaller units. It is possible to classify currencies as either strong or weak based on the amount of foreign currency that they make it possible to acquire. Various factors, including economic performance, political stability, trade flows, and investor confidence, all have an impact on the value of that particular currency. Supply and demand for money. The value of money is determined by supply and demand, just like the value of products and services is. When a greater number of individuals or corporations desire a particular currency, the value of that currency rises. Reduced demand results in a decrease in its value. Demand can increase when a nation possesses a robust economy, political stability, or commodities and services that are in high demand on a worldwide scale. As an illustration, the United States dollar continues to be robust due to the considerable size of the American economy and the fact that the dollar is the principal reserve currency of the world. Inflation and purchasing power. Inflation measures how much prices rise over time. Currencies from countries with low inflation tend to retain their value better than those from countries with high inflation. High inflation erodes a currency's purchasing power, making it weaker in the global market. For example, Zimbabwe experienced hyperinflation in the late 2000s, which made its currency practically worthless. On the other hand, Switzerland's Swiss franc is strong because of the country's long history of low inflation and economic stability. Economists often use purchasing power parity to compare how much a currency can buy in different countries. Interest rates and central banks' currency value is directly influenced by the interest rates that are established by the central bank of a country. When interest rates are higher, they have a tendency to attract international investors who are looking for better returns on their investments. This results in an increase in demand for the currency of that country. A currency can lose value when interest rates are lowered because investors may relocate their money to countries that provide higher levels of return. As an illustration, when the Federal Reserve of the United States raises interest rates, international investors frequently purchase more dollars in order to invest in American assets, which results in an increase in the value of the dollar. Economic growth and stability. Countries with strong and stable economies usually have stronger currencies. High GDP growth, low unemployment, and consistent productivity attract investors and trade partners, boosting demand for the currency. Conversely, countries with weak economies, political instability, or high corruption tend to have weaker currencies. The British pound has historically been strong due to the UK's long-term economic stability, even though the country's economy is smaller than that of the US or China. Trade balances and exports. A country's trade balance, the difference between its exports and imports, plays a major role in currency value. When a country exports more than it imports, foreign buyers need to purchase its currency to pay for those exports, driving up demand. A trade deficit, on the other hand, means the country is buying more from abroad, which often requires selling its own currency to buy foreign ones, reducing its value. For example, Germany's large export surplus helps keep the euro strong. Government debt and credit ratings. The amount of debt a country carries affects the strength of its currency. Countries with manageable debt are more attractive to investors, while countries with high debt may be seen as risky. High debt levels can lead to fears that the government will print more money to repay it, causing inflation. Credit rating agencies like Standard & Poor's and Moody's assess the creditworthiness of countries. A downgrade can cause a currency to lose value quickly because it signals increased financial risk. Fixed versus floating exchange rates. Currencies can have floating or fixed exchange rates. Floating currencies, like the US dollar or euro, are valued according to market supply and demand. Fixed currencies are pegged to another currency, such as the Saudi riyal being tied to the US dollar. Fixed exchange rates can bring stability, but require governments to actively manage currency reserves to maintain the peg. While fixed rates protect against volatility, they can limit a country's ability to respond to economic changes. Speculation and market psychology. More than $7 trillion are traded on the foreign exchange market every single day, making it the largest financial market in the entire world. When it comes to buying and selling currencies, traders and investors frequently base their decisions on their expectations regarding future events, such as changes in interest rates, elections, or economic reports. Price fluctuations in the short term can be caused by speculation, even if the economy of a country has not seen any significant changes. For instance, subsequent to the Brexit decision in 2016, the British pound had a significant decline as a result of concerns regarding the state of the economy. This occurred even before any actual changes to trade were implemented. Historical and cultural factors. A currency's value per unit is sometimes influenced by historical decisions rather than current economic strength. The Kuwaiti dinar is the world's highest valued currency unit, largely because it was pegged high when first introduced and backed by stable oil revenues. Conversely, the Japanese yen's value per unit is low because of post-World War II economic policies, even though Japan remains a global economic powerhouse. This means that a high unit value doesn't always indicate a stronger economy. Global events and crises. Overnight, the value of a currency can be affected by a variety of events, including wars, pandemics, political turmoil, and natural calamities. The United States dollar, the Swiss franc, and the Japanese yen are examples of safe haven currencies that investors typically move their money into when there is uncertainty on a global scale. For instance, during the COVID-19 pandemic in the year 2020, many currencies experienced a decline. However, the United States dollar had a rise due to its standing as a worldwide reserve currency and the faith of investors. Changes of this nature can occur suddenly and have a significant impact on different economies. The role of the US dollar in the world. As the premier reserve currency of the globe, the United States dollar holds a truly unique position. The majority of international trade, sales of oil, and financial transactions are carried out in the United States dollar format. Because central banks all over the world maintain substantial reserves of United States dollars, demand remains high. As a result of this dollar dominance, the United States can borrow money at lower interest rates and keep its currency relatively strong even when it is experiencing significant trade deficits. Because of the widespread confidence in the dollar, the United States retains a huge economic influence. So, next time you travel or hear about exchange rates changing, you'll know it's part of a complex system that reflects the entire world's interconnected economy. If you enjoyed learning about how currencies work, hit the like button, subscribe, and share this video with someone curious about money.